right, we are going to go through Guardian Life Insurance Company in this video. Now, Guardian is what we consider one of the four major mutual carriers. They have always delivered strong cash values to their policyholders, speaking actual performance, not just illustrated. But when you look at Guardian, they are personally one of my favorite companies where they have put together a very, very strong whole life insurance product, solid guarantees when you look at the guaranteed values, and have a ton of flexibility. Now, when you look at what they're doing as a company as well in terms of innovation and incorporating artificial intelligence and really trying to get to that next level, we've seen them make a lot of moves in an industry that tends to move fairly slow, talking about the life insurance industry. So in this video, we are going to focus on their whole life insurance product and really how to maximize it for cash value, how it works with loans, and really just everything we need to know. So when making a decision as far as different companies, is Guardian a company that we should consider or not, depending on our personal situation? So let's get into it. To begin, Guardian has a 2020 dividend rate of 5.65%. So they have not announced their 2021 rate yet, not as of the moment we are shooting this video, at least. They'll probably come out tomorrow. So with this, they've got a 5.65% dividend rate for 2020. They have a fixed loan interest rate, I should say, at 6%. So on paper, that seems like a negative spread. However, when we start to actually break the product down and see how it works, we'll find that it's not necessarily a negative spread. Guardian is one of the few direct recognition companies, Guardian that is, MassMutual and Northwestern Mutual with their direct recognition contracts are all companies that actually raise the dividend rate on borrowed funds. So we're going to look at an example in that, but first let's go through their loan rate features here, because this is valuable information to be aware of that not all Guardian policyholders are aware of in terms of the loan rate features. So when we start a Guardian policy, number one, we have a fixed loan interest rate at 6%. That is the case on Guardian whole life insurance products. That started in 2016 when they had updated their products. Prior to the 2016 update, the fixed loan interest rate was 8%. Now it's at 6%. Now, that is the case on all whole life insurance products for at least the first 10 years. At the 10th year, a policyholder will have the option, they are not required to, but they have the option to switch from a fixed loan interest rate over to a variable loan interest rate of 4.5%. The floor and current rate on that variable rate is 4.5% with Guardian. That functions almost identical to MassMutual's or New York Life's variable loan rate. The only difference is we have a floor of 4.5% instead of 5%, but again, we've got to wait 10 years until we have the option to select it. Now, if we elect not to select the variable loan rate, our policy, we keep the 6% rate. And the nice part is that 6% rate will eventually drop to a fixed loan interest rate of 4%. That will happen at the later of 20 years or age 65, meaning whichever one comes last. So for example, if I start a policy at age 35, 20 years from now, I'd be 55. It's not going to happen until I'm 65. So I've got to wait about 30 years if I'm starting a policy at 35 years old before I experience that 4% fixed loan interest rate. If I start a policy at age 60, in 5 years, I'd be 65. However, I have to wait 20 years until that rate drops to 4%, with the exception of a few products where they drop it in 10 years. But for the most part, it is the later of 20 years or age 65. Quick side note, with the fixed loan interest rate, so if I stay fixed, the policy is direct recognition. And if I elect the variable loan rate at year 10, then the policy will become non-direct recognition. So non-direct obviously is a bit easier to understand. No matter what happens, I'm going to receive dividends and interest on my entire cash value that are exactly the same as whatever the dividend rate is. Direct recognition, a little bit different. Here's exactly how Guardian works. So using their 2020 dividend rate, if I have $100,000 in cash value and I don't touch it, I'd receive the 5.65% dividend rate. Now, if I elect to loan out 50% of my cash value, the 50% remaining, the $50,000, will still receive a 5.65% dividend rate. However, the loaned dollars will receive a dividend rate of 6%. What Guardian does is actually increase the dividends on borrowed funds to match the loan interest rate. And really why they do this is that they do not want policyholders to feel like they're going to be punished per se for taking out a policy loan. They did the same, they still do the same thing for policyholders that have a 8% loan rate. I've actually got a contract with that, one that I took out a while ago, where when I take a policy loan, they still apply an 8% dividend on loan funds. So it's been their practice for quite some time now. Whenever I take out a policy loan, whatever that loan rate is, if I've got that fixed loan rate provision, they will adjust the dividend rate on the borrowed funds to match that loan interest rate. Now, the loan interest rate is 6%. That's, call it the cost to borrow. That does go to the insurance company. Quick side note here is Guardian does bill in advance at a discounted rate of 5.66%. And really what that means is if I take a policy loan of $10,000 at 6%, that would be $600. If I take a $10,000 policy loan and the company bills the loan interest rate in advance, I will see on my statement day one, or I should say the day after the loan, a loan balance of $10,566. Now, loan interest, we've gone through this in other videos, does accrue daily at annual simple interest. Exact same thing here. Meaning if I were to pay the loan off, say in 6 months, what would happen is I would receive a refund for the remaining 6 months that were billed in advance, but I paid the loan off early. So really what they're doing is just billing all of the loan interest up front for the entire course of the year. If I don't pay it, what happens? It tacks onto the balance, just like it would on a policy that does not bill up front if I don't pay it at the end of that policy year, that is. But we've got more content that really breaks down loan interest and how that works. Let's go into this a little bit more. So here we have a direct recognition example. So we have a policy with Guardian, 35-year-old male, paying in $50,000 per year for 5 years. Example number one, growth. Anytime we look at a policy loan, it is so valuable, in my opinion, to see that exact same policy and what it looks like when I just let it sit and grow compared to taking a loan out, paying it back, not paying it back, paying interest only. This way I can see the actual dollar cost, the actual impact, and we've got other content on that. Here we're just going to focus on Guardian's direct recognition with their fixed loan rate. So break-even point, year 4, I've paid in $200, I've got $201, same thing over here. The difference, I'm going to take out a policy loan of $200,000. First things first, what happens to my death benefit? Dollar for dollar reduction. I see it reduced by $212,000. The reason why is I've got the 6% loan interest cost and we made no payments in the first year at all. So we deferred the loan interest for a full year because you can do that kind of stuff with policy loans. Balance is $212. Death benefit collateralized dollar for dollar via the loan balance. Now, 6% cost to borrow, that again goes to the insurance company. Direct recognition, and what's going to happen here, there's my cash value reduction when I pull out the $200,000, is the money in cash will receive a 5.65% rate, and the loan balance will receive a 6% dividend. So where you can begin to see this is right here, the year I take out the loan. In the example, when I just let it sit and grow, I see my annual dividend payout is $33.41. compared to the loan scenario, when I actually borrowed funds out, now all of a sudden I'm over $4,000. The reason for the spread there is on the borrowed funds, I'm receiving 0.35% greater than what I normally would have in terms of a dividend payout. So let's zip down here to when the loan is paid off and see the net impact. Cash value paid off year 22. In the example, when I just let it sit and grow, cash value is $509,000. Death benefits just about 1.3 compared to over here. I'm at 519, about $520,000. So slight spread, 0.35, slight increase on cash value, and death benefit, about $26,000, $27,000 more. So the reason why you see greater cash values in the direct recognition example is because you received, in this scenario, that higher dividend rate on borrowed funds. Of course, dividends change over time, which would impact the values here, and that's where in-force illustrations are oh so important to always be looking at. But this is an example of their direct recognition. Let's look at their non-direct recognition real quick, only because a lot of individuals aren't aware that this exists, only because they were purely direct recognition for quite some time. And then they rolled this out in 2016. You'd have to go way back to see when they only offered non-direct recognition. But here we go. Same thing, funding for 5 years. Now we took the loan out after year 10. You know why we did that? Because Guardian offers that option to go with a variable loan rate and non-direct recognition in year 10. So we elected that option on this scenario and then demonstrated the loan in year 11. Again, if you'd like to see how to actually model this out, what levers to pull, or you'd like to see the detailed illustrations, we've got that information in our membership and agent training programs, depending on how deep you'd like to go. So, as we look at this scenario, if we look at very quickly the year you take out the loan, year 11, dividend 2627, here 2627. You don't see the same increase we saw in the direct recognition study. 200K loan, you still see the death benefit collateralized. You still see the cash value drop, just like you would in a non-direct or direct recognition policy. Doesn't make much of a difference there, but here's the difference. Loan is paid off in a shorter period of time because I only have a 4.5% cost to borrow, not a 6% cost to borrow. But when it's paid back, everything is fully restored to exactly what it would have been as if I never touched it in the first place. Non-direct recognition. The company does not recognize the fact that I take out a loan in respect to the dividend rate that they pay on money in cash value and the dollars I have loaned out. All right, let's continue on here. Having fun? I am. I love this stuff. All right. So a lot of material on that slide. We're going to move through the rest a bit quicker, only because that was the bulk of the material. So when it comes to Guardian, they have a number of whole life insurance products. They've got 8 core, call it whole life insurance products. They are their L121, which means you can fund up until age 121. Their L99, age 99. Their L95, which is a bit of a hybrid type life insurance contract as far as how the base premium comes back to cash value beginning year 2 instead of year 3. But there's 3, 121, 99, and 95. Then you also have their 10 pay, 15 pay, 20 pay, L65, and then also what is called an executive strategies whole life insurance product. And they all have pros and cons, right? If I'm interested in seeing several different products, can certainly look at them. That is something we've analyzed several times. I actually like to do it every year as dividends are updated, or if any type of product update occurs, it's really good to look at how each product is impacted as well. Now, with their products, generally, what you'll be able to do is wherever we set our base premium, let's say it's $10,000 for this example, Guardian will allow one to pay in 10x that into PUAs per year. So if I have a $10,000 base premium, I can pay in up to $100,000. That's as much as I can illustrate per year. Software will not allow you to go any higher in PUAs. Now to do that, we have to make sure we prevent a MEC, a modified endowment contract, from occurring. Also, it has to comply with the insurance company PUA limitations. So they do have a 1-year term rider that will allow this. If you do not have that 1-year term rider attached, Guardian will refer to it as a level Q term or dividend option Q. If that's not attached, the maximum PUA payment we can make per year is 3x the base. So let's put it this way. If that term rider is not attached, PUAs, I can pay a maximum of $30,000 per year without underwriting. And then with that attached, I can put another $100,000 per year. And this is all under the assumption that I have a $10,000 base premium. Once the term rider falls off, I chop it off, naturally expires, whatever it might be. I do go back to their default PUA contract language. There's a bit more to it than this as well, which again, we have in other programs, but these are the general rules that are very important to be aware of. Let's continue on. So we're going to go through one of my favorite features here about Guardian, being their PUA Flexibility. So they are one of the few companies that allows one to just pour PUAs into a policy at discretion if the policy is set up properly. So how to do this is Guardian, whenever we have a policy, we are required to pay what? Our base premium, obviously. They are very flexible, and additional payments, PUA payments specifically, can be added to the policy at leisure. Guardian will refer to this as an unscheduled paid up additions payment. Now, we do have a minimum required scheduled PUA to do this, meaning I've got to pay my base premium plus a scheduled PUA. The minimum yearly scheduled PUA is $250 or the cost of the 1-year term rider, whichever is greater. So if I have a term rider cost of $100, my minimum PUA would be $250. If I have a term rider cost of $2,000, my minimum payment would be $2,000 to cover the term cost. But it's both together, the scheduled PUA and the term. And then their unscheduled PUA is 10x the base with OYT attached or $500,000. Meaning, if I have a $100,000 base premium, the software will cap an agent out at a maximum $500,000 PUA payment. I cannot pay in another $1 million per year into PUAs, with the exception of the first year, which will usually MEC in that case. But that's the maximum limit there, $500K per year in PUAs or 10x the base. Policy design, let's look at an example here. So if I have a base premium of $10,000 and I want the ability to throw another $100,000 into the policy per year, can absolutely do this, and here's exactly how we could craft a policy with Guardian, is I can commit to the base premium. I've got my scheduled PUA, say that's $250. We'll assume the term rider is $750. So my true minimum could be $10,750 because the payment I make towards the OYT will satisfy that minimum scheduled PUA requirement as well. However, for the sake of simplicity, we're going to say I commit to $11,000 per year to cover my base premium and the term rider cost. And then at my discretion, I can throw more funds into the unscheduled PUA. Whether I hit 100 or not is entirely up to me. As I add funds into the PUA component, what happens is my 1-year term rider is naturally bought down, because what happens when we add funds into PUAs? Yes, it grows our cash value, but it also grows our whole life death benefit. How the Guardian product works is as the whole life comes up, the term comes down and it offsets the cost as well. The one danger to be aware of is if I built a policy like this, where I have the ability to pay in, call it $100,000 per year, and I only pay the minimum each year, that's where the term costs can become expensive, and I've got to be aware of that. That's where we might make an adjustment after the fact to reduce the term cost, chop it off after year 7, Depends on our circumstances and what we're trying to accomplish. But if I overshoot it too much, that's where it can hurt me. And really, if I anticipate paying in $100K per year, but only do $15K per year or just the minimum 11, that's where it will hurt more than it will help because I'm not overfunding the policy. But the key advantage is really on the flexibility here of adding funds at leisure. So, for example, if someone comes to us and says, hey, I want the ability, Steve, to put in $300,000 per year, but I don't want to get a bill for 300 grand per year. A lot of people will do this. Literally, we'll design the policy with a minimum premium, a minimum commitment of approximately $30,000. That's the base, the term cost, all that good stuff. A MEC limit of $300,000. They commit to that and then just pour in excess funds at their discretion. Whether they hit the 300 or not is completely up to them. Very flexible in that respect. So if someone's looking for that flexibility, good option to be aware of. Let's touch on another piece here. A feature they offer, which is their indexed participation feature. So this had also rolled out in 2016 when they updated several of their products. And we've got another video on this that goes into full detail on the index participation feature, which I'd encourage you to check it out if you'd like to dig into this. To sum it up, it is a nice feature to add to a whole life insurance policy that grants a little bit greater earning potential. However, we can add it and never use it at all and never be charged for it either. So let's go through a little bit of detail here. Is really what it is. It's a rider we can attach to a policy that is a dividend alternative. We have a cap rate presently at 11%, a floor or guaranteed rate of 4%. That 4% is the guaranteed rate with a Guardian whole life insurance product. If I go with the basic dividend, my guaranteed floor is 4%. Exact same thing here, regardless if I attach the indexed rider or not. Now, the potential drawback here is that there is a charge of 2% when I exercise this rider. Not when I necessarily attach it, but when I exercise it. For example, this is a rider that I can attach to a policy, and I can attach it at 0%. And what that means is 0% of my cash value will be linked or tied to the index strategy. So what that means is I'm participating 100% in the dividend, and if I have 0% tied to the index strategy, there's no charge. So I can attach it, have it at 0%, and it's the exact same thing as if I never attached it in the first place. Good advantage there. Now, if I link any percentage of this to the index, which is the S&P 500 index, meaning if the S&P 500 goes up, I go up with it, capped out at a maximum of 11% per year. I go up with it. If the market comes down, my principal is protected. I receive 0, technically the guarantee of 4%. So that's the advantage there. Market goes up, participate with the gains, comes down, principal is protected. Now, how it works, as we talked about this allocation up here, this is a nice feature. One can actually choose how much of their cash value they would like tied to the index strategy and the basic dividend strategy with Guardian. For example, we mentioned 0% initially, where if I attach it at 0%, there's no charge because I'm going basic dividend all the way through. Let's pretend that I go with a 50% blend. What this would mean is 50% of my cash value receives the basic dividend rate from Guardian, 5.65%, and the other 50% is tied to the S&P 500 index strategy. What that would mean is if the S&P 500 produces a strong gain, let's say the 11% cap, 50% of my cash value would receive that. However, 50% of my cash value would also be assessed with a 2% charge. Same thing with 100%. 100% is assessed with a 2% charge. The major potential drawback with this rider is if I went 100% and the S&P tanked or produced next to nothing, what that means is I'll still receive the guarantee, but no dividend, minus the charge that's going to net my guarantee at 2%. And keep in mind, When we look at the guaranteed rate, the dividend rate, any of these indexed assumptions with a life insurance policy, all of these assumptions are always a gross rate that are credited after the company's insurance expenses, mortality charges, meaning I would not see a net gain of 2%. At 11% minus the charge of 2%, 9% net, if things went really well, that would not be my net, right? The net will typically fall 1 to 2% below the gross rate after the insurance expenses and such. And that's with most insurance companies. Let's demonstrate a quick example over here. Here's how it would work. If I go with the basic dividend option, I have a guaranteed rate of 4%. The company declared a surplus of 1.65%. The two together give me a total dividend rate of 5.65%. That's how the dividend interest rate is made up. Now, if I elect to go with the indexed strategy instead, we'll assume a 100% allocation here. What would happen is I have the guaranteed rate of 4%. Instead of receiving the company's surplus, we're tied to the S&P 500. Let's assume the S&P did what it did in 2019, about 30%, a little bit less, but a solid year. I have a cap rate of 11%. That's how much I would earn, minus the 2% charge. So the net dividend alternative would be 9%. A lot of information here. Here's really how I view this rider. Great option to be aware of. I mean, it grants more earning potential on a whole life insurance product. In my opinion, it should not make or break a sale or be the solidifying reason why I choose one company over the other, but it's a good thing to be aware of. In my opinion, there's no harm at all attaching it, especially if it's at 0%. And then after a correction, perhaps I flip it on because I can adjust it once per year. I don't have to pick the option from the get-go. I can adjust it each year, so I can flip it on for a bit, participate in a potential upside market, and then flip it back off to increase my comfort level, if that's my flavor. So let's continue on here. Getting it near the end. Flexibility. So consumer flexibility here. Convenient for fluctuating cash flow. This is a edge Guardian has. Their online portal and mobile app are very, very convenient. They've, you can tell, invested a lot of time, resources, a lot of money into their platforms. Just over the years, I've seen them improve and get to the finish line faster because they're investing a lot of resources here. And really, you can see that when we actually use the online portal to make payments. So this could be premium payments, PUA payments, unscheduled PUA payments, and also taking loans, repaying loans, very flexible in that respect. They also have a mobile app where you can transact a lot of that as well. And if we want to go old school, of course, we can send a check too. A thing I like, this is on the agent portal, MEC tracking. So where we always talk about the MEC rollover dollars, right? So if I have the ability to pay in $100,000 per year, but I only pay in $50,000, that means I could have paid in another $50K, but I didn't. The unused MEC space will roll over, and that'll continue each year, giving me the ability to make a big catch-up payment down the road if I want to, making up for lost time. Guardian allows that. That's one method I can exceed that 10x PUA limitation as well. We've had individuals that have done that on a number of occasions, can do it quite easily. It's a nice way to really accelerate the cash value growth when you look at it. But what a nice feature is a lot of companies, you'll have to manually calculate it. I'll do that a lot of times with companies that don't have online MEC tracking, or B, request it from the company. What's the maximum non-MEC payment? Guardian makes that available right through the online portal, extremely convenient for the policyholder. Their products, they've got a lot of them. They are best suited for max funding between, I've got 5 to 15, could be 3 to 15 years. Meaning, if I want to fund a policy to the brim, to the MEC limit for 10 years, call it, you can really do a lot of good on the guarantees and non-guarantees. Same thing with a 5-year funding option. Now, does that mean you have to stop altogether after 15 years? No, not by any means. For example, we might do something like this, where 5 years, let's say someone wants the ability to pay in $100K per year. What they'll do is fund $100K the first 5 years, and then years 6 through the end, indefinitely, they may pay $30K per year or $40K, the maximum amount of money they can when a term rider is no longer attached. So they may 10x, right, go with a 10-90 split in the first 5 years and then cool off and go with a 25-75 split or 40-60, that equivalent, as time passes. A lot of times when people have a lump sum of money, they'll do that, or we'll equip it where they can just keep on stuffing the thing for 10 or 15 years. Depends on their situation, but that's really their sweet spot. You can do more, you can go longer than that, but often it requires a very large term rider, and I'm getting into technical details here. Would be happy to provide technical details if you'd like, or if you're in our membership program, you've seen them already. Strong on the guaranteed values and big on innovation and customer service. Innovation, I touched on that a little bit, just how we've seen them maneuver, especially since 2008, when the CEO just resigned, but when she ran that company, she did a phenomenal job, and that's just me viewing it from the outside. But my point here is they're big on innovation, and their customer service, you can tell that they have invested money and time and resources into those departments where they'll continue to work on a problem until it's resolved. Now, back to the product, strong guaranteed values. Let's look at an example here. So when it comes to their product, here's an example where we're funding it for 7 years. So kind of in that sweet spot, right? We mentioned 5 to 15 years. 40-year-old male, $50,000 per year. Minimum premium, optimal design. Guaranteed rate of 4%. Breaking even between years 4 and 5. That's on the guarantees, right? So you've got positive cash value year 5. He's paid in 250 grand and has 253 plus a death benefit based off the guarantees. A lot of people have purchased whole life insurance and seen the non-guaranteed values break even 13 or 14 years down the road. With Guardian and a lot of insurance companies, this is more a testament to the design to ensure that everything's set up properly. But based off the guarantees, we have that. This is the guarantees. You see this death benefit climbing by a couple bucks per year, which typically the guarantees will flatline. The reason why is we use the guaranteed rate, but the current term rider expense. And if you'd like the details, right, so if you're an agent looking at that, kind of scratching your head saying, hey, give me more information, that is in our agent training program. Then we've got their present dividend rate, 5.65%, breaking even between 3 and 4, and then a sample of their indexed strategy or indexed rider. Same thing, breaking even between 3 and 4. You've got the annual internal rates of return, which displays what I am earning each year as far as the IRR on cash value. The index, you top out at about 5.1%. So a good equivalent to the annual IRR is if someone is investing in any asset and they say, hey, I earned 8% or 12% last year in the market. That's what I earned for that specific year, the annual yield, call it. Whereas the average would factor in over the past 30 years, here's how much I have averaged in terms of performance. So average internal rate of return will be lower over a span of time because really we're factoring in the early years where we are negative. These are based off of current projections, but strong policy, strong company overall. Let's hit on our last topic here, which is one of my favorites, because I always love talking about this stuff. The topic of cash value performance. So, from an illustrated standpoint, right now, Guardian illustrates or projects weaker cash values compared to most companies. We have seen that for quite some time now, at least the past 5 or 6 years. In terms of actual performance, we've seen them deliver stellar cash values. And this is why we're so big on Whenever we look at policies, projections are great and all, but I do personally like looking at the guarantees and looking at actual performance. Do they have a track record of actually delivering, regardless of what all the projections show? Which is a whole nother conversation. But in terms of actual performance, they've always been stellar. Policies issued, so to back that up, we've got proof on this from policies that were issued. The oldest one we have on record is 1975. I have another from 1990, and then several we have put in force back in 2013 and 2014 that have all been performing on a very high level. And what's interesting, some of them that had that 8% loan interest rate, a couple individuals had took very, very aggressive loans, held them for a little bit, paid them back. So you see strong cash values because they got that enhanced dividend rate on borrowed funds. What we've seen as, call it kind of an average, and this is based on actual data, cash value internal rates of return, somewhere between that 4 to 6% range. And this, like any company and product, is critical. The design is extremely important because we've seen Guardian policies that have taken 13 to 14 years just to break even or get close to 1%. So that's where the policy design, in order to maximize the cash value, is extremely important. And that's why we talk about it so often. But overall, Guardian is a solid company, a great company to consider. If you have any questions on them or any companies, feel free to reach out anytime. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.